All right. Hi, everyone. Welcome again. My name is Yana Kolmakova, and I'm the marketing director here. Thank you again for joining our webinar today. We'll be covering a deep dive into Oracle Account Reconciliation Manager, Oracle ARCS. This is actually the third part of this series that's been focused on speeding up your close, optimizing your applications for close that may have gone wrong in the implementation process, automating and streamlining those processes for your finance teams so that ultimately you can have real-time visibility, work with accurate data, and process your close faster than before. So if you've missed any of the other webinars in the series, this is the third one. Don't worry, we'll be sending out an email with all of the replays to the entire series after this one is recorded. So a little bit about US Analytics. We're here to empower the finance office to drive strategy to picture results. We're a leading professional services firm with over 20 years experience focused on various EPM and analytics solutions, serving corporate finance teams nationally. Our seasoned teams are highly technical and functional, and we pride ourselves on being an aligned strategic partner with our clients. Today, I'm joined by our subject matter expert and practice lead for financial close and consolidation, Nair Ellis. Her experience varies vastly across numerous roles, including financial controller, developer, implementation specialist, trainer, mentor, project lead, and mentor. So if there's anyone that knows about financial close and consolidation, it's Nair, and we're so excited for her to dive fully into this topic with us today. So Nair, I'm going to turn it over to you. Here's a quick overview of our agenda that we'll be covering today. If you have any questions, you can populate them in the chat box as we go through the content, and then we'll answer them at the very end.
All right, thank you. So we will be going over some pain points, kind of doing a high-level introduction to ARCS. I know it's not a new tool, but just want to make sure you've got all the information you need in terms of high-level what this product does, what it provides. We'll talk a little bit about automation, help you visualize some of these processes. We'll talk through some rules and then considerations for migration. So, you know, some of the big pain points that we see across multiple companies, pretty much essentially any company that we work with, they have the same problems, right? The reconciliation process is very manual and time consuming. The time that you're spending trying to compile and put together a reconciliation takes away from your ability to actually review the transaction. So you're just so busy putting everything into your Excel workbook or wherever it may be you're doing your reconciliations that you're not really going through the transactions and making sure doing either a thorough or a spot check of the type of transactions that are hitting there, not just checking to make sure does it reconcile. And then as far as tracking, whether you're the preparer or the reviewer, companies have notoriously struggled with knowing where do the reconciliations stand, who has which reconciliations, which ones are due, which ones are late, which ones are done. So just overall tracking of where things stand. Inconsistent formats, that's a big one, especially for the reviewer, but even so for the preparer, putting together 10 reconciliations that are formatted one way and then shifting gears and doing it another way. And then as the reviewer, same as you're going through these reconciliations, if everything were aligned more consistently, it would you'd save time in terms of just getting your bearings on what it is that you're looking at. And then you've got the risk versus transaction volume. So there's a lot of accounts out there that are high volume, but they're a low risk account. You don't need to detail review every item that runs through that account. However, it still needs to get reconciled. So, you know, ideally you'd be spending less time on reconciliations that are lower risk, but if they're high transaction volumes, you know, it kind of is the inverse. You end up spending more time on these reconciliations that really aren't providing much benefit. So, you know, what is it that ARCS can provide, right? With ARCS, you can leverage their profile configurations to have a flexible but consistent format on your reconciliations. You can manage the process, of course, more efficiently because everything is housed in the same system. You can define your rules, which we will talk a fair amount about when we get further into the webinar. But defining these rules and attaching them to these profiles that we're creating, so that you can have the system run through and do some of the reconciliation for you. You can automate things like zero balance reconciliations. That way you can still check the box, have it done, pass your audits, but you don't have to spend time actually running through those reconciliations. You can evaluate and improve close cycle effectiveness if you're able to pinpoint bottlenecks. You can better track where reconciliations are, what is your common source of bottleneck, what slows you down in general, and improve your effectiveness. You can easily identify outliers in terms of reconciliations that aren't following suit. And, you know, of course, you can provide audit support directly from the system, and you can streamline your entire close process by having this configured and connected to other applications within the Oracle Cloud EPM suite, which includes the financial close and financial consolidation and close application, or planning, tax, etc. And you know, the big thing, automate high volume transaction reconciliations. That is a huge time saver. If you think about the number of account entity combinations that companies generally are trying to reconcile, and the volume of transactions that run through there that are very low risk, if you can eliminate even 100 of those, and each of those would otherwise have taken you maybe 15 minutes, I mean, that's a lot of time saved. So what all can we automate? There is a transaction matching module within the reconciliation tool, but even if that were not used, it is within the reconciliation tool, comes with it, but it has its own configuration that needs to be done, and we're going to walk through that as well. But before you even get there, within each reconciliation profile, you can set up automation for things without transaction matching. So again, you're not integrating it with any other tool. You're setting up rules that can be either highly rigid or highly flexible. And you know, again, you'll want to kind of weigh the pros and cons there. You want something that's more rigid for a higher risk account, something like cash. You don't want flexibility, and you don't want the system to automatically reconcile that for you. However, there will be other accounts where you'll just want it to go ahead and check the boxes and reconcile for you. These rules can be applied universally across various reconciliations of the same type. So if you've got reconciliations that let's say your prepaids, you can have them all configured the same. And you might want to use that same configuration for something else too. For AP, AR, you might want to share what type of reconciliation profile. So these rules can be attached to these profiles, and these profiles can differ while still providing you a uniform approach. And this will kind of make a little more sense as we start looking at some of the visuals we have. But essentially, when you're creating a reconciliation profile, you're gonna want to match the types for the reconciliation. So again, like if we were looking at AR, AP, if we want those to have a standard format that have the same types of columns, same structure, things like that, you can do that. And then you'll want to set up your different data sources for your input. So your AR subledger, your AP subledger, your cash, your intercompany, whatever it may be. You're going to work with your different transaction types to, again, configure it to your needs based on the risk level of the account, based on any type of positive affirmations you need before you even submit a reconciliation. You can define transaction matching and other rules, and then you could put this all together as part of the format of your reconciliation. So when we're talking about automation as it relates to transaction matching, basically how the transaction matching process works for the accounts is based on the match types that you set up and the attributes. The structure of the data can be matched, as well as you add in the rules. So again, this will make a little more sense when we in a minute here when we start adding in some of our visuals. You can define multiple data sources, and you can define the attributes existing within the data sources, so invoice number, dates, amounts, things like that. You can define your frequencies. So do you want it like a matching and balancing daily, monthly, things like that. And for your rules, you can define one or more data source, define attributes existing within the data source or other attributes as well. And again, so with your rules, you can say if everything balances out and there's no transactions, you can mark off the reconciliation as submitted and reviewed. If there are transactions, let's match them based on this rule set. For each account that's to be reconciled, it kind of follows this workflow. So you import the data, you kick off your auto matching, then you confirm everything that the system automatically matched for you, as well as you can look at the suggestions that it makes, and you can manually approve or reject suggestions, make adjustments, and then submit it. And then it can get tied into your overall reconciliation profile and then completed. So here's our kind of our visualization as we walk through this. We're going to go through an example with intercompany. So first you would go in and you'd create a match type for your transaction matching process. In this example, we're going to look at intercompany, like I said. This first tab here is the basic properties. So here we're kind of defining, okay, what is this particular one? It's an intercompany matching for entities that sourcing company 120. Pretty generic stuff here. This status of approved is just telling you what status this overall profile is sitting in. So once you can't start using this profile or associating it with reconciliations until you've approved your overall template. next you kind of get into your sources. So in this first screenshot to the left, you can see we're looking at the AP portion. And here are the attributes that I was referring to in our previous slides. So we have attributes of ID, date, invoice, AP amount, inverse amount, currency, and document number. So these are all the columns that I'm expecting to pull into or allow for it to be pulled into the system as a part of my reconciliation process. And here in the first column, you can see here whether or not it's a key. Here you can see whether or not it's required. So we have certain fields that are required: date, invoice, and inverse amount. And that's important that we're looking at the inverse amount here, because you'll see over in a minute, we're going to look at the amount here on the AR side, and you would expect your AR and AP to have an inverse relationship. None of these fields are calculated, but you can build in calculations as well. So even if, let's say, a portion of this data is brought in from a source, and then I want to calculate out a number of days or something like that, you can set up calculations as well. Here in this balance, this is kind of a key column here, your balancing attribute. We want to make sure we're balancing based off of our inverse amount. And then again, when we come over here to the second screenshot, we're looking at our second data source. And we've got a similar column set. So we've got ID, date, invoice, document, amount, currency, and customer number. So some shared properties, some that differ. Again, you've got kind of the same attributes that you're going to assign to this data source as well. You're going to mark which items are required, and like I said, you're right here, our balancing attribute is listed on amount, whereas over here we've got it on the inverse amount. We want to make sure that we're flipping the sign on one of these so that they match. Here we're moving on to our matching process of the profile. So in this intercompany example, we're defining the default attributes for matching as well as our tolerance levels. So basically your default attribute mappings and your tolerance level is what defines how flexible or how rigid you want to be in your rules. Essentially, the more rigid you are, the less effective your transaction matching becomes, the less machine automated it is, which is good for high risk accounts. But if you've got a high volume account, low risk, much like how intercompany can be, well, you will want to have your transaction matching be a little more flexible. In this particular example, we have a dollar tolerance level of 0, but some companies might want to, based on their materiality threshold, modify that number. Some number that falls well under your materiality number so that auditors can sign off on it as well. And it just reduces the amount of work that you're doing. Again, the more effective you can have your transaction matching, the more you can set up, the more rules that you can set up that automates the process for you, the more time that you're going to save overall. So we're going a little bit deeper, next steps into this rule, where we're saying here, which we'll talk a little bit more about what your other options are, but we're saying it's a one-to-one match. You can only have one invoice on the AR side and 1 invoice on the AP side. Here I'm telling you that if my source entity intercompany AR invoice amount matches within the tolerance limit, then go ahead and reconcile it. But again, in this particular example, we've got it set up as $0, but if let's say you had it set up as $1,000, if it's within $1,000, we want to go ahead and auto reconcile it. If we've got and we're matching it here with our inverse amount. If we've got the invoice numbers on there, we want it to match exactly. We want no exceptions there. And even if the system is reconciling for you and it makes it ticks and ties and makes it suggestions, and a human does still come in and approve it. So it's not to say that once it's been auto reconciled, it cannot be undone, or we think the system has reconciled something within the tolerance limit like it's supposed to, but really we want to force company 100 to go fix this amount. You can reject the transaction matching that the system has done for you. So again, in the rules, you can have multiple formats. So you can have one-to-one. In some cases, you might have one-to-many. In a situation where you might be trying to compare payables versus cash payments. So you might have several invoices to one cash payment, things like that. So you have choices in terms of what types of transactions you're going to allow the system to match up. So one-to-one, one-to-many, many-to-many, and then you have your adjustment field, which we'll talk about in a minute. And then here you'll see some examples of different type of match rules. So again, the one-to-one exact match on invoice and amount. And if I have a situation where I've got that everything exactly matched out, then go ahead and confirm it, mark it off, reconcile it for me. If I have a one-to-one exact match on date and amount, but my invoice number is not the same or not on there, then I want you to go ahead and put it in my suggestions bucket. If you have a one-to-one exact match on invoice and have a variance on the amount within the tolerance limit, then go ahead and confirm it. And so on. So these are just several kind of examples of things you can do, and these are all the matching rules that are configured to one profile. So you're not limited to a set of, well, I can only have 1 or 2 rules per profile. No, that's not the case. You can have multiple rules. Again, this kind of allows for you to be a little more flexible, but also having parameters on it. That way, you're allowing for various scenarios where you want suggestions. You're allowing for confirmation on others, and really reducing the population that you're having to look at. So if you can reduce your population from 5,000 transactions hitting that account per month, but really you only have to review and reconcile 500 of them, that's a huge cost savings for both the preparer and the reviewer. So multiple levels of savings on time. And that's more time that can be spent to actually review and analyze the transactions that are of significance that need to be looked at. Because being on the other side of the fence, being someone who used to be preparing or reviewing reconciliations, I can recall how frantic it can be during the close cycle. You're trying to reconcile. You don't you have items that you might mark to review or look at later, because sure, it seems like it falls within the parameters. You can find the offsetting transaction, you can reconcile it, but you have questions about it, or you want to review to make sure the validity of it, things like that. So there have been so many times where I recall not having the time that I needed to meet a deadline and also be able to fully analyze an account the way I'd like to. So it just, again, if you can focus on the key transactions that seem to matter and let the system take care of the redundant portions, then you as the preparer and reviewer can be astronomically more effective. So kind of coming back to our setup here, you can, those items that we had marked for suggestions, we can set things up to where it's like, okay, if it's not an exact match, it doesn't meet the threshold, not within the requirements, we can either adjust the transactions and reload the balances, or whatever we might need to do. We just know that there's something that needs to be done to address the situation. So you can make those adjustments inside the system as well. So if for the purposes of completing your reconciliation and your processing and pushing it to the next step, you can allow for adjustment types to be booked within your ARCS reconciliation. That way, again, you can, the reconciliation doesn't have to be held up for somebody else to come in and book a journal entry and prep the data for you so that you can push it back in and run through the reconciliation again. In fact, instead you can adjust it in your system and bring it back to your source TL after the fact. But again, you wouldn't lose sight of it because it is tracked separately as an adjustment. So, once the matching is set up, a new format can be created to incorporate this whole matching profile that we've been going through into a reconciliation profile. So again, in the case of this, we're gonna apply all these settings that we've just created for our transaction matching for intercompany. We can now go apply that to any intercompany profile and require that to be the format and the thresholds and all of that can be consistent across all of your reconciliations. So there, again, there's that, then you have that, the rules are established and within the system, you can't bypass them, and they follow the same structure and they can be applied across the board each time. So once you've done all that transaction matching, like I said, you bring it back to the profiles. This is a view of your profile here. So in addition to all that transaction matching, you can set up rules here as well. And these rules are the ones that you can tell the system, okay, if this GL account has had no transactions and has zero balance, I want to go ahead and mark it as complete. If this transaction had zero balance last month and zero balance this month, go ahead and mark it as complete. Because and that would be something you'd want to use maybe like on a clearing account. You always want your clearing account to be zero. So long as your clearing account is always hitting zero, you don't necessarily care that transactions came in and out of there, as long as it's zeroed out at the end of the month. So that would be a situation where you might want that kind of rule. So again, depending on the types of accounts, you'd want to set up different profiles or different rules for each type. when you're setting up your profiles, you can set up your methodology. And if you've got transaction matching also included, you would pick a methodology that includes with transaction matching. So you can set these up with or without the transaction matching. The transaction matching, again, is more effective for accounts with high volumes of transactions that you want to have kind of a leg up on your reconciliation, have it started for you, have most of the work done for you, and you just come in and it's almost as if the preparer has now become the reviewer, because the system has been the preparer on the front end, done a lot of the legwork for you. You've come in as stage 2 preparer, or whatever you want to call it, and you're coming in and just dealing with all your problem children and reconciling those. Once everything is set up, you can access your overall profiles. So your overall profiles are what drive essentially your reconciliations. A lot of companies like to do, in this one's case, we've got Intercompany 120 matching. A lot of companies like their account ID to be an entity and account number combination. That's probably what I see the majority of the time, but there are companies that like entity, account, and subsidiary or cost center or something, in addition to, or actually cost center is probably a bad example just because it's not on, you don't typically assign that to a balance sheet. But the point being that you can add levels of granularity, or you can keep it at a higher level. So in this kind of example we've got here, we've got a low risk rating. So this is one of those accounts where you'd want to have as many rules as is practical to kind of do the majority of the legwork for you. We're going to use the format Intercompany Matching. That was the format that we were setting up, where we were going through our one-to-one, one-to-many, and amount versus inverse amount, all that setup that we were working on. We now bring that in here in this format and tie it to our reconciliation. So we're tying our account entity combination, adding this format, adding the profile attributes that we were just looking at on the previous screen, the balance comparison with transaction matching. So this is kind of what ties everything together. You're bringing in all the pieces, individual, all the calculations, all the rules, all the attributes, everything you've assigned to everything that you've created. You now go and assign it to a profile. And these are the profiles that essentially, this is what drives your reconciliations. So every month, every month you open up a period, or for some you might have it quarterly. Some accounts you might have quarterly, some accounts you might have monthly. But regardless, whichever period it is, whatever frequency you have it, you would have that profile create a reconciliation for that period. So each month, each profile is generated into the period that you opened up. And here we've got another one of those rules set up that I was mentioning. Balance is 0 and it has no activity. So we're going to auto-reconcile. And we're just telling it it's a normal credit balance. Again, just something else that it'll have the system pop up as like an outlier. Okay, well, this is normal balance is credit. Well, we've got a debit here, and kind of raise the flags there. Once everything is set up, you will want to import your transactions from your source, your subledger, as well as your GL balances. So you would be, if you've got transaction matching set up, you would first be importing your transactions. So for going back to my Intercompany 120 example, I'm going to put in, I'm going to pull in my intercompany AP entity invoices, and then AR invoices. So these are the two files that I'm wanting to bring in. I'm going to import it and I'm going to submit. Once I do that, I'm going to run the transaction matching, and I have here all the balance of activities that I've brought in, the balance of everything that I've brought in. So I can see my intercompany with entity 120s. I've got this appears to be in balance, but we still have our intercompany transaction matching happening on the back end for all the individual transactions that ran through the system. So if I were to go click on there and see, okay, well, after it's processed, what confirmed matches do I have? What suggestions do I have? You can go in and start looking at your matches. You can see suggested match, and it'll tell you which rule lended it to be a suggestion, which rule lended it to be a confirmed match. So it will group into buckets all of your transactions and your confirmations for the month. And then you can go in and click on each of these match IDs and you can look at all the underlying transactions behind it. So like I said earlier, the system is doing all of this for you, but you still have the ultimate ability to override. And the system will track that history as well. So again, when it comes to the audit, you want to have the ability to show, okay, well, this is what the system had done. This was the override, human intervention that was done. Here's when it was submitted, etc. So all of that is tracked. Every move is tracked within the application. For your suggested transactions, you can again click on that ID and start reviewing everything. In this situation, I have an item over here. This is what kind of this is a match that works, right? Over here, I have one that has a variance of $80. So for this one that has a variance, I have told my profile that I want to allow for within that screen to do an adjustment type. I want to be able to book an adjustment and fix it within the reconciliation and be able to submit my reconciliation. So I can do that. I can come in here, mark my adjustment type as other, whatever it might be. Over here on my description, I just have wrong amount entered, and so on. You can put in whatever detail you need, book an adjustment for your variance, and then you can confirm that transaction and tie it out. So just in summary, what have we got here? We've got a tool that gives you consistent formats. It gives you rules to automate the processes, and it gives you tracking. You know, something that I didn't have a screenshot of, but something I've been working on recently was another company where they had a prepaid account. Within their prepaid accounts, they had several transactions that needed to be amortized. You know, of course, over each one varied. Each prepaid transaction varied. It had different amortization periods, and so they wanted the ability to track that. Well, that's something you can do within ARCS as well. Rather than maintaining an amortization schedule outside of your application, I had gone in and created an amortization schedule for them within the application. So each month, it essentially created or calculated out your total amortization expense for the period for all of your prepaids, and they took that amount, and they essentially work backwards. They let the system calculate out the amount for them, then they book the journal entry into the GL after. So there's a lot of creativity, a lot of flexibility allowed in here, and that's something else that hopefully you've kind of got a feel for or realized as we were going through this presentation, that there is a lot of flexibility in terms of how you can set things up while still maintaining your consistent formats, while still adhering to rules and structure. And again, all of it being audited, all of it being trackable. So there is no, there's clear visibility. There's no little loopholes or blackout spots or something where you can't see what's happening in your balances. You have complete visibility into all the transactions hitting, who's making the adjustments, who's reviewing, where does the reconciliation stand, and so on. Just kind of a great tool. And so that's why I was really wanting to do this presentation, was because, like I said, it's not that it's a new tool. It's a tool that's been out there for quite some time. Even on the cloud version, it's been out there for several years and working quite effectively. But it's almost one that I feel like is not pushed to the forefront enough. Everybody is always focused on month-end closing out the books, pushing out your reports, and that is critical, of course, to the monthly close process. It's critical to reporting internally and externally, but reconciliations are also a key month-end process that has to be done. Again, every month, every quarter, whatever it may be, depending on the account. And it's very time consuming. So there are tools out there to really accelerate that. And I've used as a user of the account reconciliation module and as a user of Excel, I've done reconciliations in Excel for a fair amount of years. I've done reconciliations and prepared them in a tool like this, and the time savings is astronomical. Again, just, like if you think about it for a minute, the number of transactions that hit some of these accounts, the number of accounts that you have with the high volumes of transactions, and then you throw in the account entity combination, there are hundreds of account entity combinations, and even with minimal amount of time, 10 minutes, 15 minutes for a reconciliation, all that adds up when you've got a ton of them to do. And it makes, when you don't have a good reconciliation tool, it makes all your month-end closes run up together. You don't get that break at the tail end of the month. You just roll right into pre-close activities for the following month. Kind of a vicious cycle, and it can be avoided. If you are considering migration, just really with, and this applies, doesn't matter what tool it is, ARCS, FCCS, whatever process it may be, just having that overall clear vision. If you're in the process or in the stage of considering a new tool, just considering the cloud readiness of your company and making that migration over to cloud. And that's where Oracle and really all companies are focused right now, is on the cloud technologies. So kind of making your company be prepared to take that shift, and considering all the functionality and trade-offs that you might be making from one versus another. Considering, all the functionality, the features, implementation timeline, and in ARCS specifically, if you've got ARM now and you're considering an upgrade, how easily you can migrate from ARM over to ARCS, and 9 times out of 10 it's a pretty quick shift, because the ARCS is very close to or similar to its on-prem counterpart, ARM. Okay, and do we have any questions?
Thank you, Nair. Yes, please go ahead and populate your questions in the chat. We actually had a couple that were emailed in prior to the webinar, so I'm going to ask those. Maybe they will be relevant for any of our viewers today. One of the questions was, can you also use the automation rules to prevent the ability to submit a reconciliation?
Yes. So just like you have the rules to say if it's $0 balance and there's no transactions, go ahead and auto reconcile or something like that. Well, you can also, yes, you can have the opposite. You could say, if I have unreconciled balances that are above, if I have unreconciled variances that are above $100 or something like that, don't allow the preparer to submit to the reviewer, to essentially to prevent premature submissions, or to essentially make sure that the preparer is not just clicking through and not really paying attention. So yes, you can absolutely do that.
Great. My other question that was emailed in was, can rules be different for various segments of a business? An
So in those profiles we were looking at, where we were saying, okay, well, this is an intercompany profile. I want to pull in this transaction matching. I want to pull in this profile that we set up here, and we're kind of bringing all the pieces together. A part of your configuration in your profile can be for different geographical segments. So you might have a reconciliation profile that is for EMEA or Asia, or for North America. You could have different ones, and along with that, you could have like different holiday schedules. That's pretty common too, where your rules might differ slightly, but you also have different holiday schedules. So you're to basically make sure that when you're tracking these reconciliations, you're not incorrectly marking one as late because it's a European holiday and we're over, and corporate's over in US, or vice versa, something like that. So yes, you can definitely have different rules and associations with different segments. And it doesn't have to be geographical. It could be whatever it may be.
Great, thank you. That seems like a very helpful attribute to have in a system. Okay, so are there any more questions? Feel free to, like I said, populate them in the chat. Whether they're functional or technical, we'll get them answered. And I also wanted to note, if you want to get in touch with Nair, you can do that as well. We actually offer assessments as well. So that is, if you need a little bit more of like a customized approach and to answer some more customized question based on the issues that you may be dealing with in your application, Nair is available to schedule those meetings as well.
Okay, well, so it looks like I see one other one here, comparing ARCS to Blackline. Yeah, I think Blackline is pretty much the biggest competitor for ARCS out there. Let's see, I'm trying to scroll through this question. So with EPM license, ARCS comes free. We're trying to see functionality advantages and trying to see implementation cost of ARCS. So yeah, I mean, for what I'd like to call like a plain vanilla. It's we kind of start at basically 6 weeks, 55,000 for implementation. And yes, you're right. It's like if you've already invested in Oracle EPM, ARCS comes with it free. I mean, it's one of the application types that are available to you at no additional cost. So you absolutely should take advantage of it. You can integrate ARCS then with your other modules. Like I said, plain vanilla, meaning kind of not a ton of rules. Like I'd say, like 10, 15 rules set up. We're not, and that doesn't include the transaction matching piece. But plain vanilla would be about that much. And then if you want to incorporate in transaction matching, things like that, I'd be happy to go over your particular scenario with you. But like I said, that's just kind of baseline. We started about 6 weeks for an implementation, end to end. And that usually includes again, it kind of depends on how much parallel you want or something, but that usually includes the timeline includes a month of parallel.
Nair, maybe you can expand a little bit on that, but how does total cost of ownership over the long term compare with ARCS that's already included in EPM licensing versus having like a totally separate application like Blackline? And then maybe to tag off of that is the compatibility, short term or long term.
Yeah, I mean, so there are a lot of integration tools and things out there. So it's not to say that Blackline couldn't integrate with your other Oracle EPM products or something like that. And it's just overall, yes, I think cost effectiveness wise, you're better off with ARCS. And when especially considering you've got comparable features, I think, like I said, Blackline is probably the biggest competitor out there for ARCS, and I do think they're pretty hand in hand with like pros and cons. And I'd be happy to kind of go through provide like a sheet with pros and con list, and so if we can reach out to you after and give you that, we can. But they're comparable in functionality. I think they're both pretty good tools, but if you've already invested in Oracle EPM, you've definitely have a huge cost savings, because at that point you're not paying for each individual application that you own. You're just paying your licensing fee for your users. So your users can use one application or 10. It doesn't really matter. Whereas if you're going to keep your Oracle EPM and have Blackline, well, now you're paying for two things. And I don't know for sure, but just rumor has it Blackline is not cheap. So I don't know, to be honest, like the actual cost structure of Blackline. So again, something I'd be happy to provide, give you like a detailed pros and cons list with like specific features, and as well as kind of a pricing comparison. I know we've got that internally somewhere, so I can just grab that information and send it out.
Awesome, thank you. I think that explanation was helpful. Okay, well, I don't see any other questions, so we'll wrap this up and give you guys back the rest of your day. Again, just want to thank you all for joining us. Like I mentioned before, Nair is available for any further questions that y'all might have. Feel free to reach out to us. And I would encourage you to also check out the resources on our website, because we have a ton of webinars that we do on a monthly basis, covering all sorts of topics with EPM. And again, if you want to schedule an assessment, we have those available as well. So thank you again, and we hope you have a great rest of your day and your week, and we'll see you here soon.